the markets did react. The Fed did give us some less dovish message than a lot of people expected. Just how hawkish is this message? How much has the thinking changed at the Fed?
I think they're just getting more confident about the economic outlook as they see the economy reopening and the pandemic cases start to recede. So I think it's mostly about confidence in the strength of the economic recovery and the strength of the labor market going forward. If you look at their actual forecasts, they didn't really change very much. So I think it's mostly more that they're confident that they're making progress towards their goals, and they think that's going to continue. At the end of the day, what they think they're going to do in 2023, I agree with Chairman Powell. I would not put a lot of weight on that. The outlook is very uncertain once you get beyond the next 6 to 12 months. And so, yes, the markets are reacting to the fact that the Fed may go faster than what they previously expected. But there's a heck of a lot of uncertainty around this economic outlook. We don't have a lot of experiences with how the economy likely emerges from a pandemic.
But Bill, he did say, he almost answered a question about, or can we assume then, since you took the statement about the pandemic weighing on the economy those words out in the latest missive, that you're no longer going to see such a negative weight on the economy. And I think that's the point. It isn't just that they're more confident. It's the economy has changed substantially. And another thing that changed substantially was the moves in the dots. We have a chart where we can show you just how many people now, 11 out of 18 now see 2 rate hikes in 2023. And the number of people who are looking for rate hikes, well, you can see the dot plots there. That's a big difference. But the number of people who look for a rate hike next year is up to like 7. It was down at 4 just 3 months ago.
This is due to 2 things. 1, the economy is doing better, and 2, they're more confident that this is going to continue. That said, this is pretty far out, and lots of things could change between now and then. Look, I always thought that the economy would probably come bouncing back a little bit more rapidly than people anticipated. And the Fed's slowness to respond in terms of their forecast, I think, probably, wasn't completely appropriate. Now, they were doing it in part because they wanted to keep the maximum amount of stimulus. In a way, we got a little bit of a defect of tightening of monetary policy today in terms of financial conditions. Because if people think the Fed is going to go sooner, then that weighs on the bond market, that weighs on the stock market, and voila, financial conditions are a bit tighter.
Yeah, Bill, and I actually want to take you to our next chart, which shows just the looseness of financial conditions before today, looking like the loosest since the 1990s, right? And that's obviously fed through to asset valuations. The market sentiment part of this equation, is the Fed talking about this now also, in part trying to manage expectations so there isn't a violent taper tantrum?
Well, they're certainly trying to manage expectations about when are they going to start to phase down the pace of asset purchases. That's why they're talking about tapering as opposed to actually starting to implement a change in that policy. I think over the remainder of the year, they're going to inch closer and closer to actually beginning the tapering process. Probably starts late this year or early 2022, depending on how the economy unfolds over the next 6 months or so.
And at the same time, we see some real distortions, particularly on the front end of money markets, right, just being awash with cash. Is this a bigger concern, returning to some sort of normality, or is the debate really over whether inflation is transitory or not?
Well, in terms of the short end of the yield curve, what we've seen downward pressure on short-term rates, and that's caused by the fact that the Fed's buying of assets is boosting the amount of reserves in the banking system enormously, and that's pushing downward pressure on rates. The Fed responded to that today by making 2 technical adjustments, raising the rate that they pay on overnight reverse RPs and raising the rate that they pay on reserves by 5 basis points. So that's designed to put a little bit firmer floor under short-term rates to keep the federal funds rate more in the middle of the 0 to 25 basis points range. I think in terms of inflation, I think Chairman Powell is correct that a lot of the factors that are pushing inflation up right now are probably going to be transitory. I don't think used car prices are going to keep rising, 10% in 1 month, 5% in the next month. As we see supply chains start to respond to the increase in prices, you'll probably see some of these prices that are going up very rapidly now start to turn down. So I do agree that probably the worst inflation news that we're going to see in the very near term is sort of right now. And 6 months from now, I would expect inflation to be a bit lower. The key issue, though, is how fast we use up the excess capacity in the labor market. And that's where the Fed is, and many other people are quite confused, because on one hand, you still see 7.6 million people unemployed relative to where you were in February 2020. On the other hand, you see a record amount of job openings. So is the labor market tight, or is the labor market loose, depending on how you look at it? And that's where I think the Fed has a lot of uncertainty about how much slack is there in the labor market and how quickly are we going to exhaust that slack.
Well, you know, Bill, I want to come back to this point that from March to June, this is a big shift for the Fed in terms of how they expect rate cuts, how many, when, this. Now we can talk about tapering. Inflation expectations. Let's look at a chart from the New York Fed, your old stomping grounds. And what it shows is that 1 year inflation expectations jumped to 4%. But I think what's most interesting is 3 years out. And we know these can change. Nevertheless, that we'll have like 3.5% inflation. You can argue about the numbers themselves, but it's clear there is something happening here. Is that another reason maybe why Fed officials are saying, gee, maybe we have to move things up?
I think that's right. I mean, they want inflation expectations to be well anchored around 2%. And if you go back a year or two, inflation expectations were somewhat below that. We've seen a rise in inflation expectations in recent months, both in terms of household surveys, but also in looking at the spread between Treasury nominal securities and tips. The Chairman Powell actually addressed that today. He actually said, yes, inflation expectations have moved up, but they've moved up to a level that the Fed is actually more comfortable. The Fed actually feels that they've made progress in making inflation expectations better anchored around 2%. Now, if they keep going up from here, then I think the Federal Reserve starts to get more concerned about it. But so far, they're actually pleased by what's happened rather than unhappy about what's happened.
What's the biggest risk, Bill, right now in the Fed's policy position? Is it they move too slow, and as you've argued in the past, they let the inflation get a little too hot and have to move a little too hard to stop it? Or is it they move too slow, or quickly, I should say?
I think the risk is that they're going to be too slow, because they basically said that they're not even going to start to tighten monetary policy until there's three conditions met: 2% inflation, they're at full employment, and they're confident inflation is going to move above 2%. That's a pretty late in the game to be starting to raise short-term interest rates.